Hi, everyone. Welcome to the Kimberly Cloud Show. I'm your host, Kimberly Cloud. We are back for round two with Guy Gane. Can you go ahead and announce to the world where you're calling from before we get into the questions I have to ask you?
Yes, thank you. Yes, today. I'm in Detroit. I travel a lot, but today I'm actually at my son's house sitting and dog sitting. They had to go out of town for my granddaughter's dance competition,
Oh,
so I'm here. But uh,
okay.
but yeah, it's always a pleasure to be here. I really love being at their home. So
Thank you. And I'm glad that you are there dogging and, babysitting because it's like, if you have a family to do it, why not do it? That keeps
Oh,
your house
exactly.
safer and
Absolutely. And he didn't have to go to a kennel, which he wouldn't like, and we don't have to rely on neighbors and that type of thing. My big challenge today was to make sure that Benjamin is his name, that Benjamin was going to be a good boy. So I did talk to him beforehand. We'll see, but he should be. Oh, and here I am.
well, today we're going to get into the discussion of your book. Can you tell the people what your book is called and what's it about before I begin asking you questions
Yes,
about it?
sure. The name of the book is "Managed Money: An Avenue to Wealth." And as you know, Kimberly, I've written a few books, but my background is as an investment advisor. I was a registered investment advisor and a stockbroker during my career. And in our last show, we talked about the train going off the track some years ago. So now what I do is I'm a performance coach and also do business consulting for select companies. And then I also do a weekly market update, stock market update. That market, it's called Market Watch. And marketwatch.gain wisdom, pardon me, I don't want to confuse it with the other Market Watch. The email address is marketwatch.gainwisdom.com. But every Sunday by 9 o'clock, usually, I have it into my web designer. And what I do is I walk through the market, what happened the previous week. I do a commentary as to what is going on, really in plain English as to what's going on with the markets. And I also give guidance as to where people would have the most success, in my opinion, and through my analysis, where they would have the most success to have their money placed at any particular time. And the reason I did this, Kimberly, is a few years ago, people were asking me back in 2022, what do you think is going to happen with the market and what's going on? Because things were pretty dire back at that point. And more and more people kept asking, well, what could you do? What do you suggest that I do? So what I decided to do was to do a very general, at this point, it was in August actually of 22, a very general type of update. And it's gotten much more intense since that time. But what I do is, or what I should say, what I focused on as I did this, especially at the beginning, I remember as a broker that so many clients that had not a lot of money, maybe a couple $1,000 or $10,000, $5,000, that's a lot of money. But unfortunately, a lot of stockbrokers don't like to deal with people that have really less than a couple $100,000. Now, not every stockbroker is like that. However, what I found and how I became very, very successful in my firm is the fact is that people that were never contacted by their broker, rarely, if ever, heard from them. They became my clients, and they were the ones that I managed their money. And what I would do was when the markets were strong, based on my analysis, I would make sure that their money was invested, or at least try to make sure their money was invested. But when the markets were showing weakness, I tried to make sure that their money was in a money market, which is the same as cash. What happened during that time is going back and forth. You never caught the top of the market or the bottom of the market. That's pretty impossible to do. If it happens, it's just luck, and that's all it is. But when people invest money, and we'll talk about this more in a minute, but when people invest money, they do it very emotionally, and
Emotion. I agree.
yeah, and they follow the herd. You find out that other people are going into the market, and I'm going to miss out, type of thing. Or they go the other way. Everybody's getting out of the market. I better get out too. Well, what I did as a registered investment advisor is, as I say, when I moved money, I moved everybody I had their permission to do that, and their statements came directly from the mutual fund company or the variable annuity that they were using. I didn't have ownership of that money; that was theirs. But what would happen is when we would move the money back and forth, they would get a statement directly from the company that they were with, and they always knew what was going on and what their accounts were worth. Of course, they could give me a call as well. But it's so complicated, and I can really go on and on. But I'm going to let you ask me some questions, and we'll just kind of go from there.
We're definitely going to take it slow. So tell me about November 14th, 1972, when the Dow Jones hit 1,000, the 1,000 mark in the 76 years it was developed. Can you tell me a little bit
Yeah,
about?
yeah. What had happened is in 1971, Richard Nixon had taken the United States off of the gold standard, and it really set the markets, on a trajectory up. I have some ideas that there's some thoughts that I don't think that's a good idea any longer to be off the gold standard, but that's another question for another day. But what happened is the market did reach 1,000, and then it retreated, and it never hit 1,000 again until 1980. Uh, I'm sure a lot of the folks that are listening and watching today may not have even been around in the 1970s. But as you know, when I started in the business in November of 74, the Dow was at 577. Right now we're at 39,000. But the thing is that what happened is we went into a terrible recession. Inflation went crazy in the late 70s. And it, in my opinion, was one of the causes that Gerald Ford did not become or was not reelected in 1980 because inflation was so bad. Interest rates at that time were looking somewhere in the vicinity of 16% and up. And it really took a few years into the 80s for that to come down. And it was a pretty bad time for households. But that's what it reached 1,000 back in 1972 for one day.
Wow. And do you know, well, I know you know, but what is an IPO and how can you get one from, wherever
Right.
you.
How to get involved in it. Yeah, an
Yeah.
IPO stands for initial public offering. And an initial public offering is where a company is just coming out for the first time. People will remember, and people certainly know Facebook. A few years back, Facebook came out public, and it came out, and as every new company does, they come out with an IPO. It's not the company itself, it's not Facebook or Google or whomever that comes out with the IPO. It is what's called the investment banker or the big brokerage firm that sponsors it. And if you want to get into an IPO, and I'm just talking plain English here, generally IPOs are gifts, if you will, from the stockbroker to their client. They generally, when I was in the business, what would happen is, as you know, I owned my own firm for many, many years. But when I worked for a brokerage firm, what they would do is they would offer me a certain amount of block of shares of stock if they were sponsoring that particular company. So what happens is the broker gets, let's say, 500 shares, and they can divide that 500 shares up into their best five clients, or their best client, give them 500 shares, offer that to them. But it's really generally only given to the really high net worth people, people that have done a lot of trading with that particular broker from that particular firm that is sponsoring that particular company's stock. But that's what an IPO is. It's only given from a broker to their clients, and that's the only way you can get involved. Now, know this: an IPO is done before the market opens up on that investment. So, in other words, you're buying the stock at a set price that before it starts trading. That's the initial public offering. You must sign and be aware of a 45 days, sometimes it's much more, 6 months of a restricted a stock, meaning that you cannot trade it. So if I bought the stock, let's say at $10 a share, and as an IPO, and a couple of days later, after it's traded on the market, on the secondary market, uh, let's say that stock is now worth $50. I can't sell it. I can't do that. I have to wait until the restricted period is over.
Oh
So
wow.
that's the downside. If there is a downside, that's what it is.
And tell me, what do you mean by the clients that spend more money than A clients that spend more money than the C clients, right? The C
Oh
clients,
yeah,
A through D, the A clients uh, spend lots of money versus the D clients hardly
yeah,
about
yeah.
that.
Yeah, a lot of brokers, they really don't talk about this. But you know what I mentioned a minute ago, Kimberly, that when I managed my clients' money, many of them had never heard from their brokers or their financial advisor. And what happens is, and we'll go through this: A client, B client, C client, and D client. The A client is the client that does a lot of trades. The broker calls up and says, you know, I've got this particular stock. I think we ought to take a look at it. Let's put money into it. Yeah, no problem. Well, every time a broker buys and sells for their client, there's a commission involved. So the more money that you make for the firm, and the more money you make for the broker is going to spend more time with that client. And it's not that they don't care about the D client, they just don't have the time to deal with them. And I'm going to explain them in a second. But that's what the A client is. They get a lot of attention. Many times the broker takes them out to lunch, takes them out to dinner, takes them to a ball game, whatever. They're pampered. The B client is a client that they trade fairly regularly, not as much as the A client, but they do more than just a couple of trades a year. They get attention from the broker and or the broker's team. A lot of brokers today have a team, a couple of people that work with them that will reach out to clients and so on. So the C client is somebody who trades maybe once a year. Maybe they've got an IRA. They deposit money into that. Maybe they came into some money. Mom or dad passed away and left them a few dollars, and they invest. The D client is a client that really doesn't trade at all. I mean, they put an investment in, let's say, 4 years ago into a money market, or excuse me, into an IRA, but they've never really done anything since. The money sits there. They hope they make money, but there's not a lot of attention that's paid to that D client. This is one of the biggest reasons that I started my weekly market update is for those clients that were the C clients and the D clients, because what they could do, and I'm talking about people, and I remember when I did this, Kimberly, when I started thinking about actually taking the time, and it does take a lot of time on a weekend for me to correlate and analyze all of the numbers and all of the things that go into my advice. But the thing is that I was thinking about the people that work like at Walmart or at Target, or that they have a 401k, but nobody ever tells them what to do. And chances are, when they first started with the company, they opened up their 401k. They picked a couple of companies that looked, or stocks, I should say, within that 401k that looked good. And look good, I mean, the name sounded nice. And they've never known what to do. Do I move the money? Do I leave it here? They don't even sometimes pay attention to it. Those are the kind of clients that I always loved working with, because these were the people that were really ignored. And with my firm, and certainly now with Market Watch, we pay attention to them. So I
You
don't know if that
know,
answered that question.
it you did. You actually have Money Market Watch, right? Where you, through a system, not a computerized system, but through your knowledge of being a stockbroker and a former, uh, what is it called again?
Registered investment advisor.
Registered that
Right.
RIA. Then,
RIA. Right.
you actually look at the systems and base it on like 5 to 6 different measures and not
Right.
emotion. Can you tell me about that?
Yeah. Yeah. That's a good question, actually. Uh, I don't use a computer like an AI or anything like that. I do the analysis on my own. I use my computer certainly to find the numbers, to see some of the things that are moving the markets around. I keep very well aware, even today. I keep very well aware of what the markets are doing. I just don't pay attention on the weekend. I mean, every day, multiple times during the day, I'll use my phone that we all have. And on here, anybody can find the app that will tell them what the market is doing on any particular day. What I do is I follow the numbers. I analyze what I see. I follow whatever news is coming out. I look at Treasury bills. I look at the inflation rates. I look at many different things, and based on what I'm seeing and the information that I'm gathering, I analyze all that. I use some specific. I want it's not software because I don't do that, but some specific. What's the word I want? Indicators. That's the word I wanted. Was indicators. And then what I do is I make a decision based on what I'm seeing, and I use the knowledge that I had from many years of saying, well, when this happens, usually this happens. And I have some advice for people that are watching or that are going to be listening to us at the end of where I think the markets are going to go over the next 12 months based on my analysis right now. But these are the indicators and the different signals that I'm getting from different various sources. So yeah, that's I just really feel that you have to have more of a personal touch when you're doing this type of thing, because you really can't rely on the computer to decide, should I put the money here, should I put the money there. From what I understand, though, Kimberly, there are some softwares out there that you can do that with, but they're very expensive. To become one of our subscribers, it's only $200 a year, which, from my accountant, has told me is tax deductible because it is for business.
Well said. And what's the difference between buying a stock commission and selling a stock commission?
A commission is something that a broker, when you're going to buy, let's say you want to buy 100 shares of General Motors, there's going to be a commission going in to buy, along with the commission, or within the commission, I should say, is what's called a ticket charge. The brokerage firms have a set charge that they put in. It might be $10, $15, but there is a booklet that, at least it used to be a booklet. I don't know what they use now, but there was a booklet that told us if you sell 100 shares of a company that's trading at, let's say, $25 a share, this is the top commission, this is the lower one, and you could pick in between what you wanted to do. When I owned my own firm, when I was doing the money management as opposed to just buying and selling, I only really dealt with the clients that wanted to buy a stock. I only dealt with my own clients. I wasn't out there prospecting, and I only charged them a very minimal commission because I never watched the stock for them. I mean, I kind of did, but that wasn't my job. My focus was on managing money, not watching the individual markets and or an individual stock. So for me, I always tried to save my clients as much money as I could when they bought or sold. But that's what it's done. Anytime there's a buy, there's a commission. Anytime you sell, there's a commission. You know, there's a joke in the brokerage industry, and it was two brokers talking to one another. Hey, Mike, how you doing? Oh, I'm doing fantastic. How you doing, Joe? I'm doing great. How your clients doing? Well, they're not doing too good. And the reason is that, you know, because the broker always makes money. And then there's nothing the matter with that if they're earning it, but the broker always makes money. And maybe some of the viewers or the listeners saw the movie Trading Places. Came out back in the early 80s. It's a great movie if you haven't seen it. But when they're explaining to Eddie Valentine, or Billy Ray Valentine, excuse me, when they're trying to teach him the business, there's a part in there where they say, the great part is no matter what happens, the firm makes money. And that's the way it works. Which is, again, why that A client gets so much attention, because he's paying commissions in and out. So that's why they get a lot of commission, or a lot of attention, is because of the commissions.
Okay, because this is an off the wall question. You said you like the Walmart clients and the clients that make like basically minimum wage, and you like to help them. So how can you
Right.
get a client like that can possibly grow up to 500,000 in stocks through like growth?
Yeah. Well, first of all, you have to be realistic and say if you're starting out with putting $20 every 2 weeks away, the chances of you getting to $500,000 by the time you retire are it's going to be tough to do. Um, Again, you have to be realistic, but that $20 you worked hard for, and you don't want to lose it. And the whole focus of our firm at Market Edge is what my firm is called, my company, I should say, is called. The whole purpose of Market Edge is to take a small loss as opposed to taking a large loss. Kimberly, I used to do seminars when I was a broker.
Yeah.
And what I would do is every 6 to 8 weeks, I would do these seminars. As a matter of fact, they speak about it in the book. And, I would ask people, well, if let's say your stock was at $10 a share, and now the market took a nosedive and it's worth $5 a share. What do you have to make to get even? Just to get even, not to make money, just to get back to $10 a share. I would ask people to raise their hand, and I would hear, oh, you have to make 100%, or you'd have to make 50%. Well, it's 100%, because you're starting now at $5 and you've got to work your way back up. You've got to double your money. That's pretty tough to do. So the thing is that if the market was going down, and the person in Walmart, their account, let's say their 401k was worth 2 weeks ago was worth $2,500, and right now it's worth $2,000. They've got a lot of catching up to do just to get their money back even. Well, my whole theory is you'll take a small loss, maybe 1 or 2 or 3% loss, as opposed to having to make up a 5 or 10 or 20% loss or more. So that when I looked at doing the a weekly update, it was with those folks in mind, because I really wanted to make sure that at least they had an option. You could look at what I suggested to do. I can't manage your money. You can manage your own money. But at least you would know, gee, he's suggesting maybe I should put money into an S&P, a Standard & Poor's, or maybe I should put money into the NASDAQ, into high tech, or maybe I should put my money into finance or banking or retail or whatever. And somebody can go back, which is really kind of unique about our website. Somebody can go back and look at the very first one that we did. And I have an archive that goes back all the way to the first update that I did back in August of 2022.
Wow, that is really deep. And tell me about mutual funding and stock examples.
Mutual fund and what, Kimberly?
Stock market examples, if you can.
Oh, yeah, I can. Yes, absolutely. Yes, yeah. When somebody goes into the stock market, they hear the one that we always hear about is the Dow Jones Industrial Average. There's 30 stocks on that in that index. It's nothing more than a snapshot. I don't think it's a very good snapshot any longer, but that's what it is. That tells of a few select companies and how they're doing. If somebody wants to really know how the market is doing, the large cap market, I would look at the S&P 500, the Standard & Poor's 500. What that means is that there's 500 stocks, or 500 companies, I should say, that are being represented on that index. The S&P 500 is by far the best indicator of what the stock market is doing. The NASDAQ is the National Association of Security Dealers Automated Quotations. Those are more of the technical stocks. And again, if somebody wanted to know what the tech markets were doing, they would look at the NASDAQ. If they wanted to know what small cap companies are, you would look at the Russell 2000. And that's 2,000 different companies that are represented there, that what's going on in their stock. And I always talk about where the Russell 2000 goes, the broader market generally goes as well. In order for the market to continue to go up, we like to see the Russell 2000 doing very well. If the market is not doing real well, I can look at the Russell 2000, which is one of the places that I look as well in my indicators, and I can kind of tell where the market direction is going. I call the Russell 2000 the canary in the coal mine. Many years ago, they used to put the coal miners would put a canary in there, and if the canary was chirping away, everything was okay. But if they found the canary at the bottom of the cage, that meant that there was a gas leak. When we smell gas now, like in our homes, let's say, or if you have a gas stove or whatever, that smell, this is kind of a side, but that smell is a man-made smell that the gas company actually puts in there, so we know that there's a leak. In many cases, people are not aware of that, but gas is you can't smell it. But again, that's the reason to kind of get off track here with the canary in the coal mine. Anyway, to answer the question, when you're looking at a particular stock, it's one stock. So if I'm going to buy General Motors or I'm going to buy Facebook or Google or whatever, with a mutual fund, you're spreading out your risks. The whole idea when I dealt with clients, and I think that most brokers, if not all brokers, think this way, you don't want to put all of your eggs into one basket. Right now, the darling of the market is NVIDIA. They're an AI company, as you may be aware. That company is the one that's really moved the market this year. It's done phenomenally well. It's up about 160% year to date. It had a little bit of a rough week a couple of weeks ago. The market showed it. But the thing is that one particular company was responsible for 34% of the activity and the growth in the market itself. That's dangerous because if it goes the other way, which it will, someday it will, hopefully it will be a long time from now, but someday it will. And if the market continues to look at NVIDIA as, where NVIDIA goes, so does the market, we're in trouble. But anyway, if you wanted to invest in a technology stock like NVIDIA, my suggestion would be to get a group of stocks like NVIDIA and invest the money there because you're diversifying your risk. Now, a lot of people don't have that kind of money to buy a lot of different individual stocks. This is where the mutual funds come in. A mutual fund is a portfolio of many different companies that are basically looking to do the same thing. Maybe growth, could be growth in income, which means that the dividends that those companies are paying, that the investor has the opportunity to get a quarterly dividend back from that. They could be looking at a bond, let's say a tax-free bond. Instead of buying one bond, they have a mutual fund that's invested in a lot of tax-free bonds, and the income that they're getting from that is tax-free. And then you have mutual funds that look at different sectors and where they want to invest the money. So you really have to do your homework, and you have to deal in order to buy a fund or a stock. You will have to deal with a financial advisor. You can either go to a very large firm or a small firm, and every one of us in the business would get their investments from the same well. I used to tell clients that, or prospects or attendees when I would have my seminar. I just tell them, look, we all get our water from the same well. It's just who do you want to deal with, and who do you think can give you the best service? Because at the end of the day, you can get great companies, but like I said a minute ago, these companies are not going to go up all the time. They are going to go down. And if you're getting good service, your broker, your advisor is getting back to you saying, maybe we ought to move the money because this company's not doing really well right now, or the prospects for the next year aren't looking really good. Maybe we ought to think about some other options.
Tell me about the difference between regular bonds and government bonds.
Yeah, regular bonds are issued from a corporation, let's say General Motors, Ford, any large corporation that's trading on the markets has a bond that is attached to it. Bonds are considered a little bit safer than a common stock. And let me break it down if I could. When ABC company, well, we'll pick on General Motors. When General Motors is trading, they have a degree of investments that you can invest in General Motors with. The first order is with the bond. If General Motors goes out of business, the people that get their money first, the investors that get their money first, are the bondholder, the corporate bondholder. They're the first in line. The second would be the preferred stockholder. And the third one would be, if there's anything left, is the common stockholder. That's really what most people think about, that they invest in the market, they're investing in common stock because they're taking all of the risk. If that particular company that they have money invested in goes the other way and goes belly up, goes out of business, they could lose all of their money. The bondholder will get something or should get something back. They're the first in line. But when you talk about government bonds, as opposed to just regular bonds or corporate bonds, government bonds are like treasury bills, treasury notes. Treasury bonds are a very, very safe investment, as are treasury bills, because they're backed by the full faith and credit of the United States. So if you believe that our government, our country, our government is sound and safe, we can invest there, and we're not going to lose anything there. If we lose money in government securities, really, we're all cooked anyway because they're the ones that back our money. But that's the difference between them.
What is stockcharts.com?
Stock Charts is it's a company that I use. It gives you a chart as to what type of activity is going on in that particular investment. In my market updates, I have a group of them in there from Stock Charts. I have the S&P, I have the Dow Jones, I have the Russell 2000. So Stock Charts, which is really nice, anybody can use them. Even if you don't know the name excuse me, the ticker symbol or the stock symbol of the company, you can just put it up on the header, whatever the name of that company is, and a box will drop down and tell you what the symbol is of that company. But stock charts how the activity is going for a certain amount of time. It could be on a day, could be on a month, could be 6 months. It depends on really what you want to use and what you're looking at. But I use stock charts a lot. For my analysis.
Speaking of analysis, technical analysis, can you tell me a little bit more about how the candlestick chart works?
Yeah, the candlestick charts I think are a little bit easier for people to take a look at and understand. It's one that I use, and it's kind of hard to illustrate verbally. My suggestion would be to go to my website and you can take a look at it, and those would be on there. It's just really hard to because there's so many different types of charts that you can look at. But I think for the one I use and I suggest that investors use and look at is the candlestick chart. And that's the one that will come up actually first. If you go to stock charts, that's the one that they use.
Tell me about the VIX, the RSI, and the MFI, and I think it's two more. Tell me about those.
What is it? I'm sorry. What?
VIX,
Oh, the VIX. Okay, yeah, that's the
RSI.
volatility. Yes, that's the volatility index. The volatility index is a very unique indicator for me, because what it does is it gives us the ideas of what is going on in investors' minds. So what happens here is if you see a reading in the volatility index, and this is a grouping, if you will. I'm trying to explain this simply. A grouping of investors all over the country and where their thinking is at any particular time. If the reading on the VIX is 20 points or lower, that means that investors generally are feeling fairly confident about the markets. Right now, that's where the VIX is under 20. It's around 12 to 13. I haven't started my update yet for the weekend, but we're going to be looking somewhere between 12 and 13. That's a very, very good sign that investors are feeling confident. If the VIX, the volatility index, goes to 20 and above, 20 to 30, that means that investors are getting a little concerned as to what's going on out there in the market. The economy maybe is not doing really well. They're really worried. 30 and above, 30 to 40, I should say, investors are really scared. There's something going on. We would have seen these readings a few years ago. They're really scared as to what's going on with the markets and the direction. If the reading goes in the volatility index to 40 and above, that's everybody's heading for the fire exits. They're panicking because they can't get out of the markets quick enough. Actually, this when you talk about a panic, back in 1987, when the stock market took a massive nosedive, 1989, pardon me, when the stock market took a massive nosedive, the people were scared out of their minds. And from what I understand from people that were there were clients wrapped around neighborhood blocks waiting to get into their brokerage offices to sell. So it get really scary, really scary.
And tell me about the 11 different stock exchanges.
Yeah, people are just aware of most people are just aware of the New York Stock Exchange, but there's exchanges all over the country. There's the Pacific Exchange, the Boston Exchange, the Philadelphia Exchange, and these are regional stocks that trade on that. They trade there, let's say in the Philadelphia Exchange, but they generally will also trade on the New York Stock Exchange as well. The regional exchanges are not as popular as they once were because really everything is centralized now through New York. So even though they're still there, they still adhere to the rules of the New York Stock Exchange as well.
So basically, they have your a new one that came out, I think, in 2007, a European one.
Yeah, the European, yes, yeah, and one of the exchanges combined with the European exchange, and the reason that they did that is because so many things now are global. So they felt that New York just felt it was better to have an exchange that was also invested in the European exchanges as well. So that's what that's for.
What about T bonds and T bills?
Yeah, these are what I talked about a minute ago. The T bonds and T bills, those are government securities. Those are treasury bonds, treasury bills. So again, these are very, very safe investments. They don't pay an awful lot of interest. Right now, the 5 year treasury bond, which I look at the 5 year, the 2 year, and the 10 year on my site. Right now, we really see a lot of, I don't want to say volatility, but a lot of interest in the bonds right now because of the interest rates, the inflation rate, and these are based on what the prime rate, as well as the federal fund rate. And by the way, when we hear, that people are hoping that the Federal Reserve, lowers interest rate, the interest rates that they're referring to are called the federal fund rates. These are the interest rates that the banks charge one another to borrow money overnight. Right now, that's between 5 and 5.5%. So right now, we're looking at a 2 year Treasury bond. As of last week, was about 4.62. The 5 year bonds are about 4.5. I don't have the chart in front of me, and the 10 year bond right now, I think, is about 4.52, something like that. But what happens is where we are right now is the short term rates, the 2 year rate, as I mentioned, is higher than the long term rates. We're right now called an inverted yield curve. The inverted yield curve means that the short term rates are paying higher than the long term rates. That's not a good place to be. And the market is overlooking that right now. But it's one of the things that I've been really very concerned about for a long time. And we'll talk about that toward the end as to what I think is going to happen with the economy and with the stock market in particular over the next 12 months.
The last two questions. The first one is fixed annuity versus variable annuity. What's the
Mhm.
difference?
Yeah, annuities, depending on who you talk to, annuities have gotten such a bad rap. And I really personally think that that's wrong. Not everybody, not every investor should be in the stock market. They should be in something that's guaranteed. And annuities kind of do that for you. But the good thing is that you have an option. You can go with a fixed annuity, as you mentioned. You can go with a variable annuity. And let me explain it. The fixed annuity is 100% guaranteed, and it's guaranteed by the insurance company that issues it. Annuities are only issued by insurance companies. And what happens is there's got to be in a fixed annuity, that insurance company that's doing business has to have sufficient capital reserves on hand to be able to pay every investor that is in that company in their annuities. They have a fixed annuity has a set amount of interest. Let's say, for example's sake, it's 5%. That annuity can be for 10 years, it can be for 7 years, it can be for 5 years. I don't really think that there's many annuities that are longer, fixed annuities that are longer than that, than 10 years. But with a variable annuity, you can invest in mutual funds with that. You can invest in a fixed annuity within the variable annuity. But the reason that people put money into a variable annuity, actually, there's a couple of reasons. First of all, your principal that you originally put in is guaranteed, so you will not lose money. As in a fixed annuity, you cannot lose money in a fixed annuity. But with the variable annuity, you can also invest in mutual funds. And if somebody were to look at their variable annuity, they would notice that there's many, many different funds that they could put their money into. And you can swap inside and outside. You can move money into one fund free of charge. You can move money into another fund within that variable annuity. And actually, Kimberly, a lot of the 401ks and 403bs, which are investments for people in the public sector, like the hospitals and police and things like that, you'll notice that they have variable annuities as that company that they're dealing with in the 401k. So if somebody is listening and wants to take a look at their 401k, they'll notice it's done with an insurance company. I'm not aware that anything else other than an insurance company is done in those.
Tell me about EFTs or EFT and RI or REIT, if that makes
Yeah.
it.
Okay. Yeah. An EFT is an exchange traded fund. And what that means is that they're mutual funds as well. But a mutual fund can only be transferred or moved on once a day at the end of the business day. The stock market is open between 9:30 in the morning and 4 o'clock in the afternoon. If somebody wants to buy or sell a mutual fund, that transaction is done at the end of the business day at 4 o'clock. Uh, so that's what an EFT is that it's a mutual fund. However, it's different in the respect because it can be exchanged anytime during the day. So those are very, very popular right now. The REIT, a REIT, a real estate investment trust, what
Yes.
that is that people can put money into a REIT, as it's commonly called, can put into a REIT, and they can invest money into commercial buildings. Generally, are the way, but you can also invest maybe some other types of investments where some options are maybe with corporations that want to have a diversified portfolio, meaning that with the real estate investment trust, that company will sponsor other commercial buildings within that. It's kind of like a mutual fund, but of the respect that it's only real estate, only invested in real estate. There's usually a set interest rate that's available there, depending on where the rates are at any particular time. It's not guaranteed. A real estate investment trust is not guaranteed, but they're considered very, very safe, very safe.
Okay. And where do you see the stock market going in the next 12 months?
Well, this is not good news, but I really think that the market is getting oversold right now. This week we reached a couple of new highs with the S&P 500 and also with the Nasdaq, and we're reaching new highs almost, well, if not every week, every couple of weeks. And, things are just moving along. But you remember a minute ago, I mentioned about that NVIDIA is responsible for 34% of the activity on the market right now. That's too scary for me. And, we've got a group of companies right now that are really moving the market along. It's not a broad market anymore that's moving the things along. It was at the beginning of the year, but that's not really the case anymore. NVIDIA, Apple, Microsoft, those are the type of companies right now. Those are the companies that are moving the markets the way they are. And my feeling is it depends on who gets elected. Um, I don't want to pick one over the other because there's pros and cons of the Democrats getting in as well as the Republicans. But we're in for some pretty scary times, in my opinion. And I think that the investors that are listening to this right now, it's important to have a financial advisor, or at least have a guardian angel to know what to do. And I'm not trying to drum up business for my market update. You need someone right now because these markets are too scary. And I would say to people that every once in a while I make my week free for people so they could look at it and kind of get an idea. If they were to look at it this past week, I made it free so they would know where I had encouraged people to invest their money, where to have it. But I really don't think that the markets are going to be where they are a year from now. I think it's going to be lower, and I would not be surprised. And I hate to be a fear monger here, but you asked the question. I think we're going to probably be 20 or 30% lower than where we are right now. And if you don't pay attention to your money, all of the gains that somebody would have made with this bull rally that we've had now for the last few years, especially since October of last year, the S&P is up over 20% since that point. You don't want to give that back. And that's the whole purpose. And that actually was the purpose of my business as a registered investment advisor, was to take those small losses, as I mentioned earlier, and really not take the big losses, because it's easier to make up 2 or 3 or 4% as opposed to making up 15 or 20 and 30%. I give an example, and I really, whether somebody wants to sign up for our newsletter or whatever, I give a really good example there for the NASDAQ last year. And, really what happened, that even though the NASDAQ was up over 40%, 43% last year, people would have lost money. It would have been tough to make that money up. And it's all in there. And I keep that in every week so people can kind of, look at it and say, wow, I never looked at it this way. And these aren't playing with numbers, by the way, Kimberly. These are real facts. These are really things that have happened. So again, I would encourage people to take a look at our site. And also, Kimberly, for the first 10 people that are watching today or listening today, if they'd like to send an email to me, I will send them out my book free of charge to them. My email address, if they'd like to send it, is guy@ganewisdom.com, guy@ganewisdom.com. That's GANE, wisdom.com. And I will send that out to them for free. It's available on Amazon for $4.95, but it's an ebook. But I will send it out for free for them if they'd like to take a look at it.
Yeah, the book was really good. So, how can the people reach you on all your hashtags and all your email addresses, and also your website, Market Watch? How can they reach you?
Yeah, yeah. Let me give you all that again. Again, as I mentioned a minute ago, my personal email is guy@gainwisdom.com. The Market Watch, my Market Edge website, that is marketwatch.gainwisdom.com. That's marketwatch.gainwisdom.com. Now, my main website, because as I said before, I do a lot of different things as far as trying to help people. I do personal coaching, performance coaching. I also do business consulting. And that one is gainwisdom.com. So they're all easy. And the funny thing is, Kimberly, when people say, "Well, you got a great name for all of these things," when I was a broker, my license plate was CPTLGANE, capital gain. And actually, I got a few clients because of that. People would say to me, "What are you, like a financial guy?" And I'd say, "Yeah, I'm a stockbroker." And I actually got 4 clients while I had my license plate like that. But the thing is that my real name, my family name, we're Italian, is Iovanishi. The government gave us a name when my grandparents came to this country. They gave us the name of Gane, Gane. I have no idea why it was done that way, but that's what I've been told anyway.
Well,
But
it
my
brought
mom was
good luck.
my mother was actually born in Italy, and my dad was born just after his parents came to the U.S. So
Yeah, it brought good luck. I would like to thank you for joining my show. Any last like things you would like to state about the stocks, bonds, anything?
yeah, yeah. Again, I cannot stress enough, especially over this next year, you need to talk to an investment advisor, a financial advisor. If your financial advisor is not getting a hold of you because they don't think you have enough money with them. Now, I mentioned a couple $1,000s. Believe me, I used to get clients that had over 100,000 that the broker never got a hold of them. Really find somebody that will take care of you. Whether you want to do it very easily and manage the money on your own, we will help you with, by going to our site and give you ideas as to where you can put the money. But it really is important. Don't do things emotionally. When I say don't do things emotionally, what I mean by that is that people will move money around because everybody else is doing it. They follow the herd. The herd mentality is not the way to go. There's an adage that is really kind of true. When everybody is buying, that's the time to sell. And when everybody is selling, that's the time to buy. And it really, there's a lot of truth in that, because what happens, and I would see this in the market as a broker a lot. People would say, they're watching the market go up, and people would say, I should really invest my money. I should have done this. Man, I'm going to lose out. I'm going to invest. Yeah, I'm going to invest the money. Oh, I knew I shouldn't have done that. I knew every time I buy, it goes down. So the thing is, you need to know that somebody is watching over your account. It's everybody a bit of the importance is having a doctor or an accountant, because you need to have somebody that's telling you or at least advising you. But again, don't marry a stock, don't marry a mutual fund. I've seen that, and we could spend so much more time on this, Kimberly, where people marry a particular investment. They love it, they've had it for years, they don't want to get rid of it. If the market goes down, you can always buy the stock back if you like it. And one last thing, I got a lot of one last things, but if you do own a common stock, my suggestion is, what I used to do with my clients, is put stop losses on your investment. If you buy the investment, again, let's say it's $10 a share. I would put an $8. It's a 20% loss, but it's better than losing more. But put a stop loss in maybe at $8, or maybe put a stop loss at $9. What that means is that if the stock takes a dive for whatever reason, the stock will get automatically sold for you. You can always buy it back, and if you really like the stock, you're going to get more for your money because you're going to get more shares of stock than at $8 or $9 than you would if it was at $10. So if you like the stock, you can always buy it back. That's what I mean about not marrying a stock.
Thank you so much,
So I
Mr.
hope.
King. Yes, you helped. You helped tremendously. And stay on the line. You guys take care, be safe, and I'll see you guys another time.
Thank you. God bless you all.